All right, the Federal Reserve raising the discount rate last week. Dan Greenhaus of Miller Tabak is our guest on Bloomberg. He says it doesn't really matter all that much. All right, so tell me, Bob, a listener, a fan of yours, a viewer, he's writing in, he says, take a look at the 10-year. He says, is the steepness of the curve, what happens in the steepness of the curve? Is with all the supply coming online, especially this week, right? We got to look at that 30-year TIPS auction, the inflation protected security auction. What happens? Collapse or acceleration? And he's got a PS for you, Dan. He says he likes the way you're talking. Keep talking fast.
Who's this, Tim?
No, this is Bob. Go ahead.
Bob, first of all, thank you very much. I have ADHD, so
go ahead.
I've been dealing with this since I was a kid. But to the point about the steepness of the yield curve and supply, let's touch on them both. The first is supply. The easy answer is supply doesn't matter right now. This has been an argument that's been made by bond bears for a year now that
no one's going to buy the bonds, right?
Quote unquote, out of control fiscal policy and a reckless Fed are going to drive interest rates through the roof, and we were somehow going to be Zimbabwe. Medium to longer term, this is an issue with which we deal with every day and one I'm sympathetic to. In the immediate term, reality is proving that we can get away with this. History would suggest it also. I'm not going to bore anybody with those details, but you can get away with it in the short term. We're seeing it now.
Why is that? Because we got the printing press and we're the world's reserve currency and we're the United States.
First of all, let's just say this. If 1 year ago I told you we were going to bottom and the economy was going to expand nearly 6% in the fourth quarter of 2009 and the equity market would be 70% off its bottom, where do you think the 10-year would be? Regular answers would be in the 5s, if not in the 6. So let's be clear whether the 10
right,
years,
because everyone would say, "Hey, the economy's growing, right? I mean, we're gonna have a much higher interest rate."
Exactly. Now, to tie this into the second point, the Federal Reserve is holding rates down at the short end. The yield on the 2-year, I don't have it in front of me, is 80 bips or something, give or take.
Less than a percent.
The curve is at Miller Tabak. We've been saying the curve is likely to steepen through the first quarter, if not the first half of the year. The Fed's got an anchor on the short end, and the economy is rebounding. With it, inflationary expectations, a whole other story, are going to continue to accelerate along with economic growth. The curve could steepen. I made some headlines some time ago saying it could get to 300, 325 basis points. I stick to that. We're at 290. I look less cool now saying that than I did.
Oh, you look cool all the time, Dan Greenhaus. Come on.
I have a voice and a face for radio.
Come on, and television. Now, but he also says, he follows that up. He says, rest in peace, the bond vigilantes then?
Well, the bond vigilantes, there's only so much they can do. While the Federal Reserve is at zero, things get more complicated in the back half of the year. There is a tremendous amount of supply coming, let's say $2 trillion. There's a tremendous amount of supply coming, a lot of federal programs that need to get paid for, and this is going to be a problem for the bond market over the next couple of quarters, but in the immediate term, they can get away with it. And on this point, let me just note, irrespective of spending here in the short term, a real problem for our economy are entitlement programs and defense spending. And any talking about cutting the deficit or cutting the debt without touching on these two problems is spitting in the wind. You should not pay heed to anybody who talks about this in any serious manner without talking about entitlement programs.
All right, before we talk about entitlements and defense and so on, is it a fortuitous turn of events that Greece is having all the problems that have been announced, and as well as what is going on with the euro? Because this seems like it's very beneficial to the U.S. Treasury market.
Well, if we turn, it is beneficial to the Treasury market. I mean, everything's a relative play.
Right.
If we can make this a currency discussion for a second here, the Greece situation has me still worried. I don't think the last shoe to drop has dropped, so to speak. I screwed up that.
That's okay. There are a lot of shoes to drop. There are a lot of people dancing.
There are other shoes to drop.
Spain, there's Italy,
exactly.
right? I mean, we got
and I think this is likely
Ireland.
Exactly, and Spain is a much bigger deal. I mean, Greece is a blip on the radar. Spain is one of the 10 largest economies in the world. I don't think they're necessarily continuing to evolve in terms of its problems. They've probably gotten near to the worst here, but there are certainly issues that are playing themselves out. A 20% unemployment rate alone, forget the youth unemployment rate. But this is going to continue to weigh on European bond markets. It's going to continue to weigh on the euro. If Greece gets quote-unquote bailed out in any fashion, does that quote-unquote bailout apply to Italy or Portugal or anybody else that needs it? If so, the quote-unquote flight to safety trade could continue to play itself out for a little bit here. This plays into my W outlook for the economy. If people are nervous about the path of economic expansion here in the United States, the bond market, which has continued to see flows in terms of mutual fund flows, could continue to be supported here. And I don't necessarily agree with the argument that at the end of 2010, yields on the 10-year are going to be 5.5%.
Where are they going to be?
Well, I think a more likely scenario is somewhere around 4 to 4.25. The Fed is, increasingly looking like 2011 is more likely than 2010 for a rate hike. Economic growth.
Why? Because you get it. Why? Because of the economy, and also you got these midterm elections.
First of all, you have the midterm elections. Although I would argue somewhat against that in the sense that Ben Bernanke took particularly unpopular, unfavorable tactics in 2008 to quote-unquote help save us. I wouldn't necessarily put it past him to take unpopular actions in terms of extricating himself from this, but certainly the 2010 elections, which are the guiding force of anything and everything that happens in our universe right now, are a factor. But if you're going to have a muted economic recovery, as we expect, and an unemployment rate that is likely to stay high in virtually any scenario, arguing for steep hikes on the part of the Federal Reserve and thus higher interest rates doesn't seem to be tangential to me.
So it sounds as if, okay, go ahead. Maybe don't go out so far on the curve, but you're saying you can be a little bit of a bond bull here?
I'm fine with bonds right now, and this is, we're just talking Treasuries right now.
Right.
Certainly, the best investment in the universe is not the Treasury market right now, but I think you're okay. At the same time, if we can turn this into corporate bonds for a second, you can go find 6.5% yield in the Bs and go home and sleep quite well. 6+% in an environment like this, with what might be muted equity appreciation over coming quarters, is not anything that we should turn down as investors.
All right. Well, we're not going to turn it down, and we never turn you down. I want to thank you very much, Dan Greenhaus,
thank you, sir.
Coming in. Miller Tabak, appreciate your thoughts and your insight. Thank you.